Hey, it's Dave Osofsky, and today I want to talk to you about something that I don't think is understood well enough, and that's what goes into your credit score. I've taken a lot of mortgage applications lately where people have come to me and applied, and we found that their credit score is too low to qualify, and they've had to spend a lot of time and money getting it where it needs to be. Or they do qualify, but their credit score is lower than it should be, and they have to take a much higher interest rate and much worse terms than they would have gotten with an excellent credit score. This is mostly pretty avoidable, and so I think it's important to explain how the credit score is calculated so that you can make sure that your credit score is as high as it can be. Credit scores are rated on a scale of anywhere from 300 to 850, but it's pretty rare to see a credit score under about 450 or over about 800 because it's just really hard to get the minimum or maximum amount of points in each category. But there are 5 categories that credit scores are based on, and that's your payment history, the amount owed, the length of your credit history, new credit, and types of credit. The biggest and best understood part of your credit score is the payment history part, but a lot of people don't realize that's only 35% of your score. To maximize points in this section is just paying all your bills on time, and you lose points by having any kind of lates, and the more serious the lates, the more points you lose. Worst would be any more than 120-day lates or collections or judgments and that sort of thing. 10% of your score is the types of credit, and what that just means is that it's good to have a mix of different types of credit. You don't want to just have installment loans or just have credit cards, but you want to have a mix of different types of accounts like mortgages and installment loans and credit cards. 10% of your score is new credit, which is new inquiries on your credit and any brand new accounts. Best way to maximize this is just to only apply for credit when you really need it and not to open too many new accounts at the same time. 15% of your score is the length of your credit history, and that's calculated by the average age of your credit. What this means is basically that the longer you've had accounts, the more points they give you, and even if they're not used anymore but still open, they continue to age and help your credit score. If you're constantly closing accounts and opening brand new ones, then your average length of credit history is going to be shorter and shorter, and that's going to cost you some points on your credit score. I saved number 5 for last because I think it's the most important, and that's because it's the least well understood. Your revolving balance as a percentage of your available credit is 30% of your credit score. What this means is that if you don't have any credit cards at all, then your credit score is limited right there. And if you do have credit cards and you have any of them close to the limit, or even worse, all of them close to the limit, your credit score could be 80, 90 points lower than it would normally be. I see this all the time where people come to me and I pull a credit report and they have one credit card that has a $200 limit and they'll have like a $180 balance on it. And what they don't realize is that by paying that balance down just about $130 to under 30% of the limit, their credit score could possibly go up 80 points. And, over the life of a mortgage loan, that could save you tens of thousands of dollars. So one thing you should keep in mind is that this part of your credit score changes on a monthly basis based on the last balance that was reported to the credit bureau. You don't have to wait for the score to go up. You just need to make sure that a lower balance reports to the credit bureau, and when your credit score is pulled, it'll be higher. So the month before you apply for any kind of major purchase like a mortgage or a car loan, just get your credit card balances as low as you can before the statement date comes out. Most credit card companies report to their credit bureaus a few days after the statement comes out, and then your score will be much improved by the time you actually have it pulled by the car dealership or mortgage company. There's more I could cover, but this video is already getting pretty long, so if you have any questions about credit scoring, just give me a call or send me an email. I'll be happy to help you out. And don't forget, I'm a mortgage guy, so I always appreciate a call with introductions to your friends, family, and coworkers who are looking for a mortgage. I just want you to know that I really do appreciate those introductions. Thank you very much, and I look forward to seeing you next time.